if you look at the headlines covering the regional banking sector over the past couple of years, you would think the entire industry is just one stiff breeze away from a total collapse.
Oh, absolutely. The market has definitely painted the whole mid-tier banking sector with a really broad, really skeptical brush.
Exactly. It's a narrative that's just dominated by fear, by consolidation, and this massive flight of capital to the perceived safety of the trillion-dollar mega banks.
Right. Everyone's running to the big names.
Yeah. But here's the thing about broad brushes. They inevitably cover up the underlying details. And as retail investors, those details are exactly where we find value.
Because when everyone else is running for the hills, because they're afraid of a sector, that's exactly when you need to start paying attention.
Right. You need to put on your boots, grab a flashlight, and start looking for the banks that aren't just surviving the chaos, but are actually actively weaponizing it.
Which brings us perfectly to the subject of today's analysis. We are looking at a bank that seems to be doing exactly that.
So welcome to a special Talk Tickers edition of our Deep Dive. Our mission today is laser focused for you, the retail investor.
We are taking the second quarter 2026 earnings call of independent bank ticker symbol IBCP, and we are putting it under the microscope.
Yeah, IBCP. This is a Michigan-focused community bank that actually just won Forbes' Best in-State Bank Award for the 4th consecutive year.
Which is nice, but we don't really care about trophies, do we?
No, not at all. Trophies look great in a lobby, but they don't pay dividends. We care about the math.
Right. We need to know if the underlying mechanics of this institution actually justify the really aggressive expansion they're currently executing.
Because right now, while other regional players are playing defense, shrinking their balance sheets, laying off staff, IBCP is aggressively expanding its commercial footprint and scooping up top-tier talent.
It is a really bold strategy, especially right now.
It is. So today, we're going to translate all that corporate jargon, cut through the Wall Street noise, and figure out if this growth is structurally sound or if it's just, a house of cards.
And we're going to do that by hitting the headline numbers, unpacking the story, driving those numbers, and looking at management's guidance for the rest of 2026.
And finally, we'll give you a definitive verdict on what this actually means for your portfolio. So the data tells a very compelling story this quarter, right?
It really does, but it requires a bit of translation to really appreciate what management is accomplishing here.
Let's start with the absolute top of the mountain, the headline numbers. And right out of the gate, we have a very solid beat.
A really strong showing.
For the second quarter of 2026, Independent Bank reported total net income of $18.8 million.
And just for context, if we look back at the exact same quarter last year, they were at $16.9 million.
So we're looking at meaningful, tangible bottom line growth, like almost $2 million in growth.
That $1.9 million increase in net income is substantial for a bank of this size.
Especially given the macro environment, right?
Exactly. Macroeconomic headwinds have been suppressing loan demand and squeezing margins across the broader industry, so pulling off that growth is impressive.
Now, I do want to bring up a moment from the actual earnings call transcript that I found absolutely hilarious, and I know you caught it too.
Oh, I know exactly what you're going to say.
Right. When the CEO, Brad Kessel, was reading the prepared remarks, he had a rather spectacular slip of the tongue.
He really did.
He proudly announced that they reported net income of, quote, $18.8 million per diluted share.
I can only imagine the momentary panic followed by absolute euphoria of any retail investor who was listening to that call live.
If a Michigan community bank was suddenly generating $18.8 million per share, we would not be analyzing their stock.
No, we would be bowing down to our new financial overlords.
Seriously, just to give you context, their earnings per share in the prior year period was 81 cents.
Right, so a bit of a difference there.
Yeah, so no, they did not suddenly invent a money printer in Grand Rapids. It was just a misspeak. He meant $18.8 million in total net income.
It's a funny moment, but, it also highlights exactly why we do this deep dive. Reading raw transcripts can be tricky.
Yeah, you always have to verify the spoken word against the actual 10Q filings. So, okay, net income is solid.
It is.
But for a bank, the lifeblood metric, the number that really tells you if the core engine is working, is the net interest margin, or NIM.
The all-important IM.
Right. For this quarter, IBCP reported a NIM of 3.71%. And here's the kicker that is a 6 basis point increase from the first quarter of 2026.
We really need to pause on that 6 basis point increase because, that is not just a rounding error.
No, it's not.
That is a massive achievement in the current environment.
Let's break that down for the listener because, I mean, net interest margin sounds like something you learn in an accounting class and then immediately forget.
It really does sound dry.
How should an investor actually think about IN?
Well, think of a bank like a very specialized retail store, right?
Yeah.
A store buys inventory wholesale, marks up the price, and sells it retail.
Yeah.
The difference is their profit margin.
Okay, makes sense.
A bank does the exact same thing, but their inventory is money.
Ah, I see.
Right. So they buy money from depositors,
Yeah.
by paying you interest on your checking and savings accounts.
Yeah.
That's their cost of goods sold.
Right.
Then they take that money and they sell it to borrowers in the form of mortgages and commercial loans, charging a higher interest rate.
So the net interest margin is just the spread between the interest they collect from borrowers and the interest they pay out to depositors.
Exactly. That spread is the M. And the reason a 6 basis point increase is so impressive right now is because the cost of deposits has been skyrocketing across the industry.
Right, because customers are demanding higher yields on their savings accounts.
Exactly, which normally squeezes the bank's margin. I mean, if your cost of funding goes up faster than the yield on your loans, your NIM shrinks.
But theirs went up.
Yeah. For IBCP to actually expand their NIM by 6 basis points from Q1 to Q2 means they're finding ways to deploy capital at significantly higher yields. They're actively outpacing the rising cost of their deposits.
Which is a perfect segue into their profitability metrics. They reported a return on average assets, ROAA, of 1.37%.
A very strong number.
And their return on average equity, ROAE, hit an impressive 14.52%.
Also incredibly strong.
Now, I want to make sure we don't just throw alphabet soup at the listener here. Let's unpack ROAA first. Why does it matter, and is 1.37% actually good?
So return on average assets is essentially the ultimate test of a bank management's efficiency.
Okay, how so?
It tells you how good they are at taking all the assets sitting on their balance sheet, the cash, the securities, the loans, and turning them into actual net income.
Right. Are they actually making money with the money they have?
Exactly. And the golden benchmark in the banking industry has historically been 1%. If a bank can generate a 1% ROA, they are considered to be performing very well.
So hitting 1.37% isn't just clearing the bar, it's like vaulting completely over it.
It is a phenomenal figure.
Yeah.
It shows that they're not just hoarding assets, they're putting every single dollar to work efficiently.
And what about that return on average equity, that 14.52% figure?
That is equally important. ROAE measures how much profit the bank generates with the money that shareholders have actually invested.
I always like to think of ROAE from the perspective of a small business owner. Like if you and I open a restaurant together.
Okay, I like this analogy.
Right, and we each put in $50,000 of our own money, our total equity is $100,000.
Right.
If the restaurant makes $14,520 in pure profit at the end of the year, our return on equity is 14.52%. It tells me exactly what kind of return I'm getting on my specific skin in the game.
That is a brilliant way to conceptualize it, honestly. And in the banking sector, hitting an ROAE above 12% is generally considered strong.
So pushing almost 15%.
It's exceptional, especially for a community bank that doesn't have the massive non-interest revenue streams of an investment bank like, Goldman Sachs or Morgan Stanley.
Okay, let's round out the core data dump with a look at their foundation. Because growth is great, but only if the foundation can actually hold it up.
Absolutely, you need a strong capital base.
Their tangible common equity ratio, or TCE, climbed to 8.9%, which is up from 8.7% at the end of the first quarter.
A nice sequential increase.
And total deposits hit $4.9 billion. That is a $100 million increase just since the start of the year.
We really have to translate that tangible common equity ratio because it is arguably the most important metric regulators look at when evaluating a bank's safety.
Please do. Why tangible? What makes equity intangible?
Good question. Tangible common equity strips out all the fluff from a bank's balance sheet.
Fluff like what?
Well, when banks buy other banks, they often pay more than the literal book value of the assets.
Right, a premium.
Exactly. That premium is recorded on the balance sheet as goodwill or intangible assets. But in a crisis, if the bank were to be liquidated, goodwill is worthless. You can't pay off depositors with goodwill.
Right. You can't take good vibes to the grocery store.
Precisely. So the TCE ratio looks only at the hard, tangible equity the actual capital buffer the bank has to absorb losses before depositors are at risk.
And they are sitting at 8.9%.
Yeah, an 8.9% TCE ratio is a very thick armor plate. It means almost 9% of their total tangible assets are funded by true equity capital.
Which has to provide massive comfort to both regulators and investors.
Oh, massive comfort.
And seeing deposits grow by $100 million in a single quarter is also a huge sigh of relief.
What?
I mean, ever since the regional banking panic a couple of years ago, the big fear has been capital flight, right?
Yeah.
Retail depositors pulling their money out of community banks and sticking it into Chase or Bank of America.
Yeah, the flight to safety. But IBCP is proving they can not only retain their deposit base, but actively grow it.
Which is the raw fuel they need for their lending engine. You can't make loans if you don't have deposits.
Exactly.
So if we look at the headline numbers in isolation, this looks like a pristine quarter. But we promised to play the game of beats and misses.
Yes, we did.
Because beneath the surface of these strong top-line numbers, there is a really fascinating tug-of-war happening on the income statement. Let's look at the major beat first.
Okay, let's hear it.
Non-interest income came in at $15.3 million. Management's own internal forecast for this quarter was a range of $11.3 million to $12.3 million.
That is a staggering beat. I mean, coming in $3 million over the high end of your own guidance on a $12 million base is huge.
It's massive. But here's the catch, and this is where I have to push back on the pristine narrative a bit.
Uh-oh.
They missed on expenses. And they missed hard.
They did.
Non-interest expense for the quarter hit $37.8 million. Their forecasted ceiling was $37 million, so they broke right through their own expense guidance.
Right through it.
Now, if I am a retail investor and I see a company's expenses blowing past their own projections, my alarm bells immediately start ringing.
As they should.
Right, like, does this management team have a spending problem? Are they burning cash to chase growth? Is this an operational red flag?
It is the most logical question to ask. If you are just using a stock screener and looking at quarter-over-quarter expense growth, IBCP looks like they are losing control of the budget.
Yeah, it looks messy.
But this is the exact reason why we dive into the actual earnings transcripts. Because when you translate the CFO's commentary, this expense miss transforms from a red flag into a very justifiable, calculated investment.
Okay, I'm going to hold your feet to the fire on this. Defend the spend.
I will happily defend it.
Where exactly did this extra cash go, and why shouldn't investors be worried?
So let's break down the CFO, Gavin Moore's explanation. He isolated the excess spend into a few very specific, non-recurring buckets.
Okay, what's the first bucket?
The largest culprit by far was a $4.4 million merger-related cost. Now, we are going to dive deep into their acquisition of HCB Financial Corp a little later in the deep dive, but you have to understand the mechanics of bank M&A.
Right, mergers and acquisitions.
Exactly. When you buy another financial institution, you don't just shake hands and swap stock. You incur a mountain of upfront costs.
Like what, though? What actually costs $4.4 million before the banks are even fully integrated?
So many things. Investment banking advisory fees, legal counsel to navigate the regulatory approval process, severance packages for redundant executives, and most importantly, IT preparation. You have to spend millions preparing to merge two entirely different core banking software systems.
Wow, okay, I didn't think about the software side.
The key takeaway for the investor here is that this $4.4 million is a one-time toll booth. Once you pass through it, that expense disappears from future quarters. It is not a structural increase in their daily operating costs.
Okay, I'll accept that. M&A is expensive, but it's an investment in future earnings power. What else drove the miss?
The second item was a $400,000 litigation accrual.
Oof. Now, the word litigation in an earnings report usually triggers a panic sell-off.
Absolutely. Nobody likes lawsuits.
Especially not banks.
But in the banking sector, having a litigation accrual is standard operating procedure. It is actually a sign of conservative, responsible accounting.
How is a lawsuit a sign of responsible accounting?
Well, under GAAP accounting rules, if a bank faces a legal dispute, say, a disagreement over a commercial loan default, or some localized employment dispute and they determine a loss is probable and can be reasonably estimated.
That's to report it?
Right. They have to take the expense now, even if the court case won't be settled for a year.
So they're essentially putting $400,000 into a rainy day jar on the balance sheet, just in case they lose or need to settle.
Precisely. It is a non-cash expense in the current quarter that prepares them for potential cash outlay in the future.
Got it.
And again, this is a localized, specific accrual. It's not a sign that their baseline legal expenses have permanently increased.
Okay, that covers the merger and the lawyers. Was there anything else pushing up expenses?
The final piece of the puzzle was what the CFO described as elevated advertising expenses. Specifically, they ran a targeted promotional campaign offering incentives to attract new deposits.
Ah, the classic open a checking account and we'll give you a $300 bonus strategy.
It's exactly that. The fight for deposits in 2026 is absolutely brutal. We already talked about how they grew deposits by $100 million this year.
Right.
Well, that growth didn't happen by accident. They had to pay for marketing to acquire those customers.
Makes sense.
But importantly, more explicitly stated on the call, that this specific promotional campaign has been terminated. The marketing spend is being dialed back down, although there is a slight lag as the final incentives are paid out.
So if I am summarizing this correctly, if we take that $37.8 million top line expense number and we strip out the $4.4 million for the merger toll booth, the $400,000 for the legal rainy day jar, and we adjust for the temporary marketing blitz that has already ended.
Right.
Their core recurring operational expense run rate is actually perfectly in line with their original guidance.
Exactly. The underlying engine of the bank is not burning cash recklessly. The management team has not lost their discipline. They simply absorbed some heavy strategic one-off costs this quarter.
That completely flips the script on the expense myth.
It really does.
But it also brings us to a fascinating mathematical reality. If they absorbed all of these elevated expenses, millions of dollars in extra costs, and they still managed to deliver $18.8 million in net income, which was a beat over last year.
Right. They beat it.
They must be doing something absolutely incredible on the revenue side to outrun those costs.
And this is where the story gets really compelling for Independent Bank. The true narrative of this quarter isn't about how they managed expenses. It is about how they supercharged their revenue.
Okay, let's dig into the story behind the numbers then. Because when you read through this transcript, there is an undisputed star of the show, and it is their commercial lending engine.
Oh, absolutely. The growth metrics here are just staggering, especially for a community bank in Michigan.
Let me give you the exact figures from the call. Total loans for the bank grew by $106 million in the quarter. That represents a 9.8% annualized growth rate across the entire portfolio.
A nearly 10% annualized loan growth in a macro environment where most banks are tightening their credit standards and shrinking their balance sheets is wild.
But it gets even crazier when you peel back the layers and look at where that growth is coming from. The commercial loans specifically grew by $92.6 million.
Yeah.
That equates to a massive 16% annualized growth rate for the commercial portfolio alone.
And what's fascinating here is the sheer intentionality behind that growth. Management didn't just stumble into 16% commercial loan growth. They engineered it.
How so?
Well, throughout the transcript, you hear them repeatedly use this exact phrase, remixing earning assets.
I have to be honest, the first time I read remixing earning assets, I pictured the executive team in a nightclub acting as a DJ for the balance sheet.
That is a great image, but a little off base.
Yeah, we need to translate this because this concept seems to be the secret sauce of their entire quarter.
How would you conceptualize it?
Okay, think about it like managing a fantasy football team. You have a salary cap, right? You have a set amount of money you can deploy. If you have a player on your roster who is taking up a chunk of your budget but only scoring 2 points a game, you don't just keep them on the bench forever. When their contract is up, you let them go.
Exactly.
You take that freed up budget and you draft a rookie who you know is going to score 10 points a game. You didn't increase your overall budget. You just remixed your roster to generate a higher return.
That is an excellent analogy. A bank's balance sheet works exactly the same way.
Really?
Yeah. The bank has a set amount of liquidity, let's call it their salary cap, which is mostly made up of customer deposits. Over the past few years, when interest rates were near zero, banks took a lot of those deposits and bought safe, low-yielding assets like government bonds or mortgage-backed securities that paid maybe 2% or 3%.
Because there was nowhere else to get a safe return back then.
Exactly. But now we are in a structurally higher interest rate environment. So what is IBCP doing?
Right, what are they doing?
As those old 2% bonds reach maturity and pay out, the bank gets that cash back. Instead of taking that cash and buying new bonds, they are actively funneling that liquidity directly into their commercial loan pipeline.
Oh, they are dropping the 2-point player and drafting the 10-point player.
Exactly. And we know exactly what that new player is scoring because the CFO gave us the data. He noted on the call that new commercial originations are yielding an average of 6.41%.
Think about the spread on that. If a bond rolls off the books paying 2.5% and you instantly deploy that exact same dollar into a local business loan paying 6.41%,
you have massively increased your interest income without having to raise a single new dollar of deposit.
it is brilliant. And because they are pouring so much money into these new higher yielding loans, that 16% annualized growth rate, they are actively pulling up the yield of the entire historical commercial portfolio.
Yep.
The transcript noted that the total commercial portfolio yield now sits at 6.06%.
That is the magic of the remix. It is a mathematical certainty. Every single day, as old, low-paying assets fall off the books, they get replaced by new, high-paying commercial loans.
And if we tie this back to our earlier discussion about the net interest margin, that NIM expanding by 6 basis points, this remixing strategy is the smoking gun.
It absolutely is.
While other banks are sitting around crying about the high cost of deposits, IBCP is proactively manufacturing margin expansion by aggressively rotating their asset base into higher-yielding commercial paper.
It highlights the difference between a bank that is a victim of macroeconomic tides and a bank that is actively swimming. They're controlling the variables they can actually control.
But the commercial lending engine wasn't the only thing padding the revenue this quarter. We have to talk about how they crushed their non-interest income guidance by $3 million.
Oh, sorry, that huge beat.
Because when I dug into the transcript, I noticed a couple of incredibly quirky, almost hidden wins that really boosted the bottom line.
The non-interest income line item for a bank is usually where you find fees, wealth management fees, overdraft fees, service charges, but occasionally you find windfalls.
And they had 2 distinct windfalls this quarter. The first was a $1.6 million Visa equity gain.
A very interesting little detail.
The transcript explicitly stated this was the result of exchanging Visa Class B2 shares for Visa Class C shares during the quarter. Now, I consider myself a pretty financially literate guy, but I had to go down a massive rabbit hole to figure out what a Visa B2 share even is.
It is one of the most fascinating pieces of banking trivia out there. It requires a brief history lesson.
Give it to us. How does a Michigan community bank suddenly make $1.6 million off of Visa stock?
Okay, so before Visa went public in 2008, it wasn't a standalone corporation in the way we think of it today. It was essentially a consortium owned by thousands of banks. When Visa did their IPO, they obviously transitioned to a publicly traded structure. But there was a massive problem looming in the background. Visa, and by extension the banks that owned it, were facing monumental antitrust litigation from retailers regarding swipe fees.
The famous merchant litigation. Retailers were suing because they felt Visa was price gouging them on every credit card transaction.
Exactly. So to protect the new public shareholders from these legacy lawsuits, Visa created a very complex share structure.
How so?
They gave the public investors Class A shares, but they gave the banks that originally owned the network Class B shares. These Class B shares were highly restricted. They couldn't be sold on the open market.
Wait, really? Why?
Because their value was tied to the outcome of that retailer litigation. The banks basically had to hold these shares in escrow to cover potential legal settlements.
Okay, so a bank like IBCP has had these weird restricted Visa shares sitting on their balance sheet for over a decade.
Yes, for 16 years, in fact. But as these massive legal liabilities slowly get resolved or negotiated down over the years, Visa occasionally allows the banks to convert a portion of these restricted, illiquid Class B shares into a different class of shares, in this case Class E shares, which are more liquid, and essentially unlock the trapped value.
So this $1.6 million gain isn't from IBCP's bankers doing anything brilliant today. It is essentially a financial windfall from an asset they have owned for 16 years finally being unlocked.
Correct. It is a one-time boost to non-interest income. It is not recurring, so you can't build a long-term investment thesis around it, but it is a very nice, tangible injection of capital that bolsters the balance sheet this quarter.
A $1.6 million bonus check from the ghosts of banking past. I love it.
It's a nice surprise.
The second hidden win in the non-interest income category was a $2.5 million gain on mortgage loan servicing. And the transcript provided a great comparison point. In the same quarter last year, that gain was only $500,000.
Wow.
So we are looking at a $2 million year-over-year jump.
This is another area that requires translation because the mechanics of mortgage servicing are deeply counterintuitive.
Explain it to me, because when I think of mortgages right now, I think of 7% interest rates and absolutely dead origination volume.
Right.
I mean, nobody is buying houses right now if they can avoid it. So how is the bank making an extra $2.5 million on mortgages?
Well, so you have to separate the act of originating a mortgage from the act of servicing a mortgage.
Okay.
When a community bank like IBCP originates a mortgage for a local home buyer, they very rarely keep that 30-year loan on their own balance sheet. They package it up and sell the actual loan to an agency like Fannie Mae or Freddie Mac.
Right. They want the quick origination fee, but they don't want the 30-year interest rate risk.
Exactly. However, even though they sell the loan, they often retain the mortgage servicing rights, or MSRs. This means that even though Fannie Mae owns the debt, IBCP remains the face of the mortgage to the customer.
Okay, so IBCP is the one collecting your monthly payment, managing your tax and insurance escrows, providing customer service,
and dealing with late payments.
And they get paid a fee for doing all that administrative work.
Right. They get a percentage of the loan balance every single year as a servicing fee. Because of this guaranteed future cash flow, these mortgage servicing rights are capitalized as an actual asset on the bank's balance sheet.
Okay, so MSRs are an asset, but why did the value of that asset jump by $2.5 million this quarter?
This is where it gets counterintuitive. The value of a mortgage servicing right is directly tied to how long the bank expects that loan to exist.
Wait, meaning what? If a customer pays off their mortgage early, the servicing fee stops?
Yes, and the MSR becomes worthless.
Right, the cash flow disappears.
So think about what happens when interest rates are plummeting like they were in 2020. Everyone with a 5% mortgage rushes to refinance down to a 3% mortgage. The original loans get paid off instantly.
Ah, I see.
In that environment, the lifespan of a mortgage shrinks, and the value of the bank's MSR portfolio collapses.
Oh, but right now we are in the exact opposite environment. Rates are high, and they are staying high.
Exactly. If you are sitting on a 3% mortgage right now, you are treating it like a precious heirloom. You are never going to refinance into a 7% mortgage unless you face an absolute life catastrophe.
So true.
Therefore, the expected lifespan of all the existing mortgages that IBCP is servicing just extended dramatically.
Because nobody's prepaying their loans.
Exactly. And because the loans are going to stick around longer, the bank is going to collect those servicing fees for a much longer period of time. Under accounting rules, the bank must reevaluate the total value of these MSR assets every quarter.
Wow.
Because high interest rates have killed refinance activity, the expected cash flow of the portfolio surged, forcing the bank to record a $2.5 million gain to reflect the increased value of the asset.
That is absolutely brilliant. It is a built-in natural hedge on the balance sheet. High interest rates completely crush your new mortgage origination volume, which the CFO admitted is down across the board, but those exact same high rates actively boost the value of the servicing portfolio you already own.
It is a textbook example of why diversified revenue streams, and specifically having both an origination and a servicing platform, is so critical for a bank's stability. When one side of the seesaw goes down, the other side goes up.
Okay, we have talked about the impressive commercial growth. We have talked about the Visa windfall. We have talked about the MSR hedge. The bull case is looking incredibly strong, but it is my job to poke holes in this thesis, and I am not going to let management off the hook that easily.
Go for it.
We have to address the elephant in the room. And for any investor looking at a bank, the elephant is always credit quality.
It has to be. A bank is a highly leveraged entity. You can grow your loan book at 20% a year and look like a genius on paper. But if those loans start defaulting, the leverage works in reverse. It wipes out your profits, eats into your tangible capital, and can sink the institution.
And there is a primary bearish data point buried in this transcript that we absolutely cannot ignore. Non-performing loans, or NPLs, ticked up. They now sit at 74 basis points of total loans, which equates to roughly $32.8 million.
That's a noticeable jump.
For a conservative community bank in the Midwest, seeing non-performing loans tick up is usually the first dark cloud of a brewing economic storm.
It is the first metric that short sellers look for.
So I need you to explain this. What is going on here? Is the Michigan commercial real estate market starting to crack?
This is a perfect example of why relying purely on quantitative data without the qualitative context of the transcript is dangerous.
Tell me more.
If you just saw the NPL ratio trending up from 50 basis points to 74 basis points, you might hit the sell button, assuming systemic rot. But Joel Rahn, the head of commercial banking, provided vital context during the Q&A session.
I read his explanation, and frankly, I want to push back on it, because his explanation actually terrified me even more.
Oh, tell me why.
Because he stated that this is not a systemic issue across hundreds of small businesses. He explicitly noted that approximately 2/3 of this entire $32.8 million exposure is tied to one single commercial development project. One project.
Okay, I see your point.
If I am an investor, concentration risk is my biggest nightmare. How on earth is having 2/3 of your bad debt tied to a single rotting basket a good thing? To me, that suggests a massive failure in underwriting a whale of a client.
That is a very fair critique, and concentration risk is always a valid concern.
Yeah.
But let's look at the mechanics of resolving a bad loan.
Okay.
If a bank has $20 million in bad loans spread across 50 different small businesses, a local bakery going under, a mechanic closing up shop, a dry cleaner defaulting that indicates a systemic rot in the local economy,
Right.
it means the bank's basic underwriting models are failing across the board. Resolving 50 different defaults takes an army of workout officers and years of grinding attrition.
Death by 1,000 cuts.
Exactly. But if you have one large commercial development project that goes sideways, and Ron noted that this specific project is currently bogged down in a complex legal dispute that is an isolated event.
Okay, I'm listening.
It is a bespoke failure. It doesn't mean your underwriting algorithm is broken. It means a single developer ran into a single catastrophic hurdle, whether that is zoning, partnership disputes, or supply chain failure.
So you are saying a single massive headache is better than a chronic systemic disease?
Without a doubt. Furthermore, Wren explicitly stated that this project is heavily collateralized by real estate, and it is simply stuck in the legal process. He told analysts, it is a legal process, and it just always moves slower than we want it to move.
So translate the timeline of a commercial default for the listener. What does it actually mean when a loan becomes non-performing? Because I think people hear that and assume the bank just set $32 million on fire.
Not at all. Non-performing simply means the borrower has stopped making their scheduled payments for a certain period of time, typically 90 days. The loan is moved into a special workout status. The bank is not writing off the balance.
Right, they still hold the cards.
In a commercial real estate scenario, the bank holds the deed to the property. If the borrower cannot get back on track, the bank will go through the legal foreclosure process, take physical control of the asset, finish the development, or sell it to another developer to recover their principal.
It just takes time, and the lawyers have to get their pound of flesh.
Exactly. And to give listeners even more comfort on this exact point, I want to highlight another metric that completely neutralizes the fear around this NPL uptick.
What's that?
Joel Ryan noted that the bank's actual net charge-offs for the entire first half of 2026 were a minuscule 3 basis points.
Okay, define the difference for the layman. Non-performing loans versus net charge-offs.
A non-performing loan is a loan that is currently a headache. The bank is fighting to get the money back, but the collateral is still there. A charge-off is when the bank throws in the towel.
They've given up.
They have seized the collateral, they have sold it, and the proceeds weren't enough to cover the loan balance.
Yeah.
The difference is a realized permanent loss. The bank physically subtracts that lost money from their capital.
So let me make sure I have the math straight here. They have 74 basis points of loans that are currently a legal headache, mostly because of one stubborn developer, but their actual realized losses, the money they have actually had to write off across a multi-billion-dollar portfolio for the whole first half of the year was only 3 basis points.
Yes.
Which equates to roughly $633,000.
Exactly. It is a fraction of percent. It shows that their credit discipline, their core underwriting, and their collateral requirements are incredibly strong.
And didn't they also pad their reserves this quarter just to be safe?
They did. They took a $2.7 million provision for credit losses this quarter, which was the absolute high end of their forecast.
A provision is essentially moving money from the profit column into a dedicated risk reserve on the balance sheet, right?
Correct. They are looking at that one big legal headache and saying, we think we will get our money back, but just to be conservative, we are going to set aside $2.7 million out of our current earnings.
Oh, that makes sense.
It is proactive risk management. They are identifying the problem child, they are reserving for it appropriately, but the actual bleeding of cash through realized loan losses is almost non-existent.
All right, I will concede the point. You have successfully defended the credit quality. It is a localized headache, not a systemic heart attack.
A very apt description.
So we have unpacked the historical data. We understand how they generated the $18.8 million in income. We understand the expense miss, the remixing strategy, the MSR hedge, and the NPL reality. But this is the stock market.
Indeed it is.
The market is a ruthless, forward-looking machine. The market doesn't pay you for what you did yesterday. It pays you for what you are going to do tomorrow.
Which brings us to the most critical part of this analysis management's guidance.
Let's pivot to the third pillar of our talk tickers format, what management says is coming next. And honestly, reading the forward guidance in this transcript felt like reading a different language compared to the rest of the banking sector.
It really did.
Most banks right now are talking about hunkering down, navigating headwinds, and preserving capital. IBCP sounds like they are preparing for an invasion.
The guidance provided in this call is arguably the most aggressively bullish part of the entire presentation.
Let's start with the commercial lending pipeline. We just spent 20 minutes raving about their 16% annualized growth in the commercial portfolio. The natural skeptical question is, can they possibly keep that up? Is that a one-off spike or a sustainable trend?
According to Joel Rahn, it is sustainable.
Yeah, he stated on the call that he expects low double-digit commercial loan growth for the remainder of 2026.
Projecting 10% to 12% loan growth in the back half of 2026 is an incredibly confident forecast. But what is truly fascinating is how they are fueling this pipeline.
Right, because the fear is always that a bank achieves double-digit growth by lowering their credit standards. Hey, everyone else rejected this loan, we'll take it. That is how you blow up a bank.
But that is not what IBCP is doing. The transcript details a very specific, aggressive hiring spree. They aren't lowering standards to win business. They are acquiring the bankers who already control the best business.
Okay, wow.
Management noted that they have added 8 commercial bankers year to date, bringing their total to 53 highly experienced commercial bankers spread across 8 teams statewide.
53 commercial bankers for a bank of this size is a massive sales force. Let's talk about where these bankers are coming from, because this ties in to the broader macroeconomic narrative.
This is the story of market share capture. Joel Rahn explicitly stated that they continue to see massive opportunities to acquire talent and customers from regional banks.
This is my favorite part of the thesis. Think about what happens in the real world when a massive regional bank buys another massive regional bank, or when a mid-tier bank decides to do a strategic restructuring to cut costs. The result is absolute chaos.
The disruption is palpable. Branches are closed to save money. Long-standing credit policies are suddenly rewritten by a risk committee in a different state. But most importantly, highly successful relationship managers get frustrated. They are buried in new bureaucracy, their lending limits get slashed, and they spend more time dealing with internal integration meetings than actually serving their clients.
And what happens to the client? The local manufacturer who has been banking with regional BankX for 20 years suddenly finds out their personal banker was laid off or quit in frustration.
Exactly.
Now they have to call an 800 number to try and get a line of credit approved.
And that exact moment of frustration is when an agile, localized community bank like Independent steps in.
So they just scoop them up.
Yes. IBCP is systematically targeting these frustrated, high-performing bankers trapped inside the chaotic regional giants. They offer them a home with less bureaucracy, local decision-making, and aggressive growth targets.
And here's the kicker in commercial banking. The client loyalty is rarely to the logo on the building. The loyalty is to the banker.
Exactly. It's relationship banking 101. When IBCP hires a frustrated veteran banker from a competitor, that banker immediately picks up the phone and calls their 50 best clients.
Right.
They say, I've moved to Independent Bank. We can improve your loans faster here. And the clients follow them.
So when IBCP adds 8 commercial bankers this year, they aren't just hiring 8 employees. They are essentially acquiring 8 entire portfolios of high-quality commercial business, stripped directly from their competitors.
They are weaponizing the chaos of regional bank consolidation.
It is a phenomenal strategy. The big banks are too busy digesting their own mergers to realize that agile community banks are eating their most profitable market share out from under them.
And that dynamic is exactly what gives management the confidence to project low double-digit growth for the rest of the year.
But organic growth through poaching talent isn't the only thing on the horizon. We have to talk about the M&A upside, because right after the second quarter officially ended, a massive future catalyst was triggered.
The HCB Financial Corp acquisition.
Exactly. Management highlighted that this acquisition officially closed on July 1st, 2026, just a day after the Q2 books closed. Now, for the listener, HCB Financial is another community banking franchise, and IBCP bought them primarily to expand their geographic footprint and acquire their deposit base.
M&A in the banking sector is always a double-edged sword, though. It looks great on a PowerPoint presentation, but the execution is notoriously difficult.
Right. Bank mergers are infamous for going horribly wrong during the IT integration phase. We have all read the horror stories. Two banks merge, they try to match their software systems together over a weekend, and on Monday morning, customers can't log into their accounts.
The debit cards are declining. Direct deposits disappear into the ether. It causes massive reputational damage and customer churn.
It is the single biggest risk of any bank acquisition. But what really caught my eye in the transcript is how deliberately IBCP is handling this integration.
They are taking it slow.
Yeah, management explicitly stated they are running HCB and IBCP completely separately as separate subsidiaries until a massive system conversion scheduled for November 9th.
Which is an incredibly prudent, mature strategy. They are entirely de-risking the immediate post-close period.
So for the next 4 months, if I am an HCB customer, nothing changes for me. I go to the same branch, use the same app, talk to the same teller.
Correct. By delaying the system conversion until November 9th, IBCP is buying themselves 4 clear months to plan, map the data, run extensive dummy testing, and train employees, all without disrupting the daily operations of either bank.
It prevents the chaos that causes customers to flee. But let's talk about the payoff. Because you don't buy a bank just to run it as a separate subsidiary forever. You buy a bank for the synergies. And the CFO, Gavin Moore, dropped an absolute bombshell number regarding those synergies.
It's a cost-saving projection.
He stated on the record that their goal is to realize a 40% cost savings on the HCB expense base by early 2027 at the latest.
40% cost savings. That number is the holy grail of bank M&A.
Break that down for the listener. How does a bank magically eliminate 40% of another company's expenses without destroying the business they just bought?
It comes down to back office redundancy. When 2 banks combine, you suddenly have 2 of everything. But you don't need 2 of everything. You don't need 2 human resources departments. You don't need 2 chief financial officers or 2 separate legal teams. You don't need to pay for 2 separate audit firms.
You trim the corporate fat.
Exactly. But the biggest savings actually come from technology and real estate. Banks pay millions of dollars a year to core processing vendors, companies like Fiserv, FIS, or Jack Henry, to run their internal software.
Oh, right.
When IBCP integrates HCB onto their own core system on November 9th, they get to cancel HCB's expensive IT contracts. Furthermore, if HCB has a branch sitting directly across the street from an existing IBCP branch, they can shut one down, saving on rent, utilities, and staffing.
Consolidating the physical footprint.
Right. And here is the beautiful part of the math. Every single dollar of that 40% expense base that they eliminate drops straight down to the bottom line as pure, unadulterated profit for IBCP shareholders. It requires no new loan origination, no new marketing. It is just the mathematical efficiency of scale.
So basically, we have a massive catalyst arriving in early 2027. It is going to artificially juice the earnings power of this combined entity simply through ruthless efficiency.
Exactly. It is a structural earnings enhancement that is almost completely independent of the macroeconomic environment. Whether we are in a recession or a boom, those cost savings are locked in.
Okay, speaking of the macroeconomic environment, I have to play devil's advocate here. I want to push back on one final piece of management's guidance that felt, well, almost delusional in its optimism.
I think I know where you're going with this. Let's hear it.
The CFO projected that their net interest margin, that all-important spread we spent so much time discussing, is going to expand by 2 to 4 basis points per quarter for the remainder of 2026.
He did. Which sounds wild, right?
It sounds delusional. I mean, look around at the world right now. We are in a wildly unpredictable interest rate environment. The Federal Reserve is completely data dependent, giving mixed signals every month. The yield curve is doing absolute gymnastics. Is a projection of steady, guaranteed, quarter-over-quarter margin expansion just pure hubris?
It is a very fair challenge. For 90% of the banks out there, projecting steady NIM expansion in this exact environment is the fool's errand. They're at the mercy of the Fed. But if you analyze IBCP's specific interest rate risk position, their asset liability management, it is actually highly realistic.
Okay, I'm going to need you to unpack asset liability management, or ALM, because that is the most jargon-heavy concept in banking. How are they insulated from the chaos of the Fed?
Asset liability management is the science of matching the duration and repricing speed of your assets, your loans with your liabilities, your deposits. The CFO provided a very detailed simulation analysis in his prepared remarks. He stated that the bank's balance sheet is closely matched for interest rate changes of plus or minus 100 basis points.
What does closely matched actually mean in plain English?
Let's use extreme examples. If a bank takes in a ton of customer deposits that pay a floating interest rate, meaning if the Fed raises rates, the bank immediately has to pay the customer more. But the bank used all that money to write 30-year fixed-rate mortgages at 3%.
That bank is a ticking time bomb because their cost of funding will skyrocket, but the income from the mortgages is locked in at 3% for 3 decades. They will bleed to death.
Precisely. That is a massively mismatched balance sheet. Now, look at IBCP. To be closely matched means that they have meticulously structured their balance sheet so that if the Fed raises rates by 1%, the amount of their loans that are tied to floating rates and will immediately reprice higher is roughly equal to the amount of deposits that will also reprice higher.
The extra income from the floating loans perfectly offsets the extra cost of the deposits.
Exactly, and vice versa. If the Fed cuts rates by 1%, the drop in loan income is offset by the drop in deposit costs. They aren't heavily skewed in one direction. Through a combination of specific loan structuring, deposit betas, and potentially using interest rate swaps, they have neutralized the macro interest rate risk.
So they're essentially indifferent to whatever Jerome Powell decides to do on television.
Essentially, yes, for standard movements. He went on to say they have modest exposure to massive rate drops, but they actually benefit slightly from massive rate hikes. But the core takeaway for the investor is that they are structurally insulated from macroeconomic rate turbulence.
Okay, I understand the defense mechanism. But if they are insulated and neutral to macro rate changes, how can they practically guarantee this 2 to 4 basis point expansion every quarter? Neutrality means staying flat, not going up.
They guarantee the expansion by relying on the internal engine we discussed earlier, the remixing strategy.
It all connects back to the fantasy football roster.
Exactly. When you are closely matched on your balance sheet, the macro environment no longer dictates your margin. Your actions dictate your margin.
Wow, right.
Because they are systematically taking liquidity out of maturing 3% bonds and physically redeploying it into 6.4% commercial loans. The mathematical certainty of that localized action forces the overall margin to expand. They are literally forcing the yield up from the inside out, regardless of what the yield curve is doing on the outside.
That is a phenomenal piece of financial engineering. They have taken complete control of their own destiny. They aren't hoping for a favorable macroeconomic environment. They are manufacturing their own localized yield curve through aggressive, targeted commercial lending.
And that is exactly why projecting a 2 to 4 basis point expansion per quarter is not wishful thinking or hubris. It is simply the mathematical output of their current, ongoing operational strategy.
Wow. Okay. We have covered a truly massive amount of ground today. We have dissected the headline earnings beat and the truth behind the CEO's EPS slip-up. We've explained the nuances of the expense miss, revealing the merger toll booths and litigation jars. We've uncovered the 16% commercial growth engine and the sheer genius of the asset remixing strategy.
It's quite the list.
We've explained the historical quirks of Visa shares and the counterintuitive nature of mortgage servicing rights. We've contextualized the non-performing loan bump, proving it's a localized developer headache rather than systemic rot. And finally, we've mapped out the massive 40% cost savings coming from the HCB acquisition and the ironclad nature of their ALM duration matching.
It is a dense, complex, but incredibly rewarding narrative to untangle. This is exactly why reading the transcript is mandatory for serious investors.
Which brings us to the final destination of our deep dive. I need to prompt you for the ultimate verdict. After tearing apart this Q2 2026 earnings call, after looking at the balance sheet, the growth metrics, and the M&A strategy, what is the bottom line? Is this a bullish or a bearish signal for the retail investor?
I will take a very opinionated stance here. Based purely on the data we've reviewed, it is undeniably bullish.
Don't hold back. Summarize the thesis for us.
The core of any long-term banking investment thesis rests on 2 pillars: the quality of the lending engine and the discipline of the management team. The underlying commercial growth engine at Independent Bank is incredibly strong, fueled by a brilliant strategy of poaching top-tier talent and market share from disrupted regional competitors.
Right.
Furthermore, the margin expansion they're experiencing is structural rather than accidental. It is the direct result of a deliberate, well-executed asset remixing strategy on a duration-matched balance sheet.
And the NPLs.
The one major red flag that the algorithms would scream about the uptick in non-performing loans is revealed to be an isolated, localized legal dispute that is already thoroughly reserved for. The fortress is secure, the credit quality is pristine, and the army is advancing. It is a highly bullish setup.
I love the clarity. So let's translate that bullish verdict into actionable advice for you, the listener. If you are currently holding IBCP stock in your portfolio, or if you are on the sidelines considering initiating a position, what does this deep dive practically mean for your strategy?
It means you are looking at a high-quality, localized community bank play that offers a very attractive risk-reward profile, particularly in a volatile market.
Right. And from a very practical cash flow standpoint, you actually get paid to wait for the real fireworks. Independent Bank pays a 28-cent quarterly dividend,
Which is fantastic.
so you get to collect that yield quarter after quarter, providing a floor to your returns while you wait for the massive catalyst to hit. And that catalyst is the 40% cost savings from the HCB merger, which is going to structurally juice the bottom line significantly in early 2027. You have a stable, profitable present with a built-in mathematical earnings accelerator arriving in the near future.
It is an incredibly compelling setup for a patient investor who understands the mechanics of the trade.
It absolutely is. And as we wrap up this specialized Talk Tickers deep dive, I want to pass the mic back to you for one final thought. We started this whole conversation by talking about how the banking sector feels like a minefield right now, dominated by fear and consolidation.
The search for clarity in a very chaotic environment.
Exactly. Based on everything we just uncovered about how IBCP is operating, what is the final provocative takeaway you want the listener to mull over as they look at their own portfolio?
We spent a lot of time discussing how IBCP is actively gaining market share and poaching top talent from retreating chaotic regional banks. They are explicitly weaponizing industry disruption.
Yeah.
And that raises a fascinating question for you, the retail investor, to consider. As the mid-tier banking sector continues to consolidate over the next decade, as the regional giants get increasingly bogged down in regulatory bureaucracy, integration headaches, and massive overhead, are the agile, aggressively expanding localized community banks like Independent Bank actually the safest, most lucrative growth plays left in the entire financial sector. It challenges the deeply held Wall Street convention that bigger is always safer. In this environment, faster, leaner, and more focused might just be exactly what wins.
That is a phenomenal thought to end on. The agility of the community bank versus the bureaucracy of the regional giant. We want to thank you so much for joining us for this expensive deep dive into Independent Bank's Q2 results. We hope we've helped translate the jargon, clear up the murky waters of this earnings call, and give you the tools to analyze the banking sector with a little more confidence.
Keep questioning the headlines, dig into the mechanics of the balance sheet, and always read the transcript.
Until next time, keep an eye on the data and happy investing.